Welcome to our podcast series, Furthering the Frontiers, brought to you by Digital Frontiers Institute. My name is Sarah Corley and I'm Deputy Director at DFI, and I'm your host for today's podcast on financial regulation and supervision. Are they the same or are they different? I'm joined today by my guest, Nolwazi Hlophe, who is also Deputy Director at DFI and leads on all things regulation and supervision focused for us. Nolwazi's previously worked at the Central Bank of Eswatini and Senfri and has much to share with us on the topic of regulation and supervision. Welcome, Nolwazi.
Thank you, Sarah. And hello to everyone watching our podcast, and welcome as well. I used to work for the Central Bank, as Sarah has mentioned, and I'm currently the Deputy Director for Digital Frontiers for Financial Regulation and Supervision. So I focus on all our courses across all our programs that fall under what we're creating now, a faculty of financial regulation and supervision. And I'll speak about our courses more towards the end of our podcast. But now I'll hand over to Sarah.
Thanks so much, Nolwazi. And I can see that we're going to be in good hands for our podcast today. I know I use the term, and I'm sure others do as well. We use the terms regulation and supervision, sometimes interchangeably, thinking that they mean the same thing. But through chatting with you, I know now that they are not. And you're going to unpick what some of the differences are, and also try and help us understand what the contribution they make to the mandate of central bank in terms of price and financial stability. We'll also look at who they oversee, what powers they have, and as well explore some of the key challenges that they face and how they are supporting innovation, market development, and financial inclusion. So let's get started with that first important question, Nolwazi. What is financial regulation and supervision? Are they different? Are they the same? Is the difference important? Please tell us.
Yes, Sarah, I think this is a great starting point. It's important to note that financial regulation and financial supervision are different. Financial supervision, I'll start with it, is the assessment and enforcement of compliance by financial institutions with laws, regulations, or other rules that are intended to ensure that they operate in a safe and sound manner and that they hold sufficient capital reserves to support the risks that they may face in their business. Whereas financial regulation now is looking at the background information that informs supervision, and financial regulation refers to the rules and laws that firms operating in the financial industry, such as banks and non-banks, need to comply with. However, financial regulation is more than just having rules in place. It's about ongoing oversight as well and enforcement of these rules, and that is done through financial supervision. So the main objective of regulation is to ensure market confidence, that people trust the financial system, to ensure financial stability, which is a common mandate amongst many central banks, which contributes to the protection and enhancement of stability of the financial system, as well as consumer protection to make sure that there's a proper level of protection afforded to consumers and correct levels or sufficient levels of recourse that they have available at their disposal. So it's key to understand the difference between the two and how they influence or feed into each other. So financial regulation is the laws and the regulations I've mentioned, and then financial supervision enforces those rules and regulations that have been given by regulators. So they work hand in hand in that manner, and financial supervisors contribute through their activities towards building an evidence base using the data they've collected for that policy making and regulations, future regulations can be based on or drafted on.
Brilliant, Nolwazi. So that makes it really clear for me that they are different, and it's important to not use the words interchangeably, that they mean quite different things. So building on that then, what are the different types of supervision, and how do the different types contribute to the general central bank's mandate of price and financial stability?
I think that's a very good question, especially from our first discussion. It's important to note that there's different types of supervision. So what we're most all familiar with is microprudential supervision. That is where the central bank or the financial institutions regulator will supervise individual institutions in the financial system, thereby making sure that each institution is complying to regulations, guidelines, and frameworks from the regulator. But since the global financial crisis, central banks and regulators realized that they also need to conduct macro-prudential assessments or supervision to ensure that the whole system is working and that they can manage or mitigate against systemic risks or contagions that result in systemic risk of the financial system. So macroprudential supervision is the systemic approach of supervision, whereas micro is the institutional approach to supervision. So they contribute, especially macroprudential supervision, it contributes to the financial stability mandate of the central bank by ensuring that the whole system moving together complies to regulation and is safe and sound.
Great, so that makes it much clearer. I think I often used to think about it as just being sort of overseeing financial service providers, but actually the mandate is much bigger and much wider than you initially sometimes think it is. So obviously they have a large mandate, they have a lot of powers to exercise their function. So what mechanisms are in place that give them those powers, and how do they influence things such as gender and financial inclusion, which is a big agenda that many of us here at DFI and across the globe are working on?
So financial regulators or regulations inform the supervisory framework in each jurisdiction, along with guidance as well from standard setting bodies that we'll touch on a bit later. But so taking from this framework, or rather regulations created from laws like what we know as acts, give power to the central bank or the regulator or supervisor to perform their action. And then the supervisor can develop a framework that is relevant to their context on how they'll conduct their activities, where they plan their structure, which tools and techniques they'll use, and the activities may also include how they'll collect data, how they'll license new institutions, and how they'll identify their key stakeholders and collaborate or cooperate with them. So gender inclusion is a big topic right now. And I say gender because we're moving away from focusing on sex data, as we all are more familiar with sex disaggregated data, whereas gender disaggregated data speaks to a more inclusive nature instead of just only focusing on your typical male or female, as we're now seeing that other people identify maybe as non-binary or genderqueer. So expanding that definition means that supervisors now can collect data from the institutions to see how the behavior of certain segments of the consumers is, and monitor and give advice. So thereby, that's what I mean by an evidence base for policy making, that data will form advice from analysis of that data to inform policy on which direction it should follow on gender and even financial inclusion, because they'll be able to see from the data they receive how many accounts are used, how many are dormant, how many are being opened, and at what rate, which will help the regulators and policymakers decide what the next steps are.
Brilliant. So what I'm hearing from you is, regulators and supervisors have a very big role, a very big remit, and a lot of things to think about. And it's ever changing. I mean, the world that we live in is ever changing. Digital, especially digitalization and digitizing of finance, that's really changing. So we have to have a lot of respect for our regulators and supervisors, and also they must be facing quite a lot of challenges. Can you give us some insight as to sort of some of the challenges they're facing and what they're doing to tackle them?
Yes, Sarah, I think that's really important to note, because I mean, as much as they have all these endeavors to encourage market development, accommodate innovation, expand their supervision capacity, this also comes with challenges and risks as well. So one of the first challenges I think it's key to address of that regulators and supervisors face, currently a lot of countries are seeing this in the developing economy space, is moving from compliance-based supervision or regulation to risk-based supervision or regulation, where risk-based supervision means that sufficient resources or proportional resources are allocated towards supervising institutions depending on how much risk they pose to the financial system. So I think adding on to that, if you're looking at it as a process, from then using either risk-based or compliance-based supervision, is then the data collection is another significant challenge that supervisors face. So this is from data collection, validation, and analysis of this data. So in data collection, supervisors may face key challenges due to some of them receiving data manually or even in hard copy format. In addition, submissions from financial institutions may be delayed, and when they try to validate that data, that might also delay them being able to conduct their analysis if they have to do a back and forth with the financial institutions. Supervisors may sometimes need to supervise many institutions, but they have limited staff resources. And this can limit their ability to ensure compliance with regulations, especially where on-site inspections are required, where the supervisors physically need to visit the offices of a certain institution they've identified or deemed needs further inspection towards achieving their supervisory objectives. So when you think about the fact that supervisors have limited resources, they always have to think about making choices and trade-offs in risk reduction, because somehow they have to make things work with the limited resources that they have. But at the same time, these trade-offs are not so straightforward because they differ by context. And so an example of this is that the governing body of a regulator could move supervision resources into policy making or the policy division to create detailed rules and guidance for digital financial services providers. And why I emphasize on detailed is because at least that removes any regulatory or supervisory uncertainty from the institutions and makes it easier for them to comply or submit whatever is required by the regulator. So this could make it easier for, as I said, the remaining supervisors to assess when past breaches have occurred. But this at the same time limits supervisors from being able to not only being past or backward looking, but to also being forward looking in their approach, and leaves them sort of having a blind spot of potential issues that they may face in the future in their financial system.
And you talked there about trade-offs, and it must be difficult sometimes to make those decisions, those calls. What do you have the resources to focus on and not? And I guess that's a source of frustration both for the supervisors and regulators themselves, but also sometimes for those who are working in collaboration with the regulator and supervisor. And so then that leads to my next question was, a lot of people listening to this podcast, a lot of them are going to be from institutions who are regulated by and supervised by the central banks. So, how can what would your recommendations and thoughts be on, how can we collaborate better? How can we communicate better? How does central banks and regulators and supervisors communicate with their stakeholders and work with their stakeholders? It seems to me that there's the possibility that these relationships aren't always smooth. How can we encourage them to work well together?
I think the first thing is definitely to start on what you said, making sure that they work together. And something that I always say is that private sector participants or your financial institutions struggle to learn how to speak regulation. And it's similar where you see that regulators don't necessarily or very well speak financial institution. So you find that there's that disjoint in communication where the regulator or supervisor ends up being seen as this big brother who just wants to say no to everything. But as a former regulator, I always say, I am a person, same as you. You can talk to me, we can talk and make sure we help you and guide you towards complying with the law. But I think before even getting to that talking point or that talking place, it's important for supervisors to identify who they need to talk to and see how they may be affected by certain challenges in the financial system and how those people perceive the challenge that they are also that the regulator or supervisor is seeing in the financial system. So some key stakeholders of supervisors involve or include consumers, which are often overlooked. They are very important because ultimately they're the end users of all of these services. But they also include, as I've mentioned, supervised institutions or your private sector providers, include the media as well. And media is a key player because they define how the supervisor is perceived by the public. This also then is internally looking within the supervisor regulators institution, the central bank, towards the stakeholder being senior management within the bank and the board. When I say the bank, I mean the regulatory body or supervisor institution. So also within themselves, and as well as other stakeholders are other regulators. Your telecommunications regulator per se is very key when it comes to e-money issuance regulation if it's issued by a telecommunications company. And then furthermore, the other stakeholders are government ministries, especially because if the Ministry of Finance is the policymaker for the central bank, which would be the regulator, they need to have a very good relationship to make sure that they have synergies in their objectives to work together in the long haul. And then lastly, I think the other key stakeholders that are often overlooked are just the relationship between staff and peers within the supervisory agency. How do they work with each other? In different departments, do they share data? Do they collaborate? How does that work? Those relationships also need to be worked on. So those mechanisms for stakeholder collaboration, I mean, we've all heard of MOUs in terms of references that can be used to help drive these or ensure that the stakeholder collaboration has enough meetings or has enough interaction between the different stakeholders. But as the staff within the supervisory body also needs to decide within themselves how to collaborate so that they can perform their duties using the various tools that they have at their disposal. So by tools, I mean your off-site, on-site inspections, your thematic reviews, as well as market monitoring. And this is key because it will help supervisors be able to better understand their whole financial system and the possible risks. And this will be, it can only be achieved through collaboration. An example I can give, when I was at the Central Bank of Eswatini, I worked in the Financial Stability Department. So that's more of your macro-prudential supervision. We needed to work well with the Bank Supervision Department because for us to conduct a systematic view of the banking sector, we needed to get all of the returns of the banking sector, which are submitted to the Bank Supervision Departments, so that we can aggregate them and see how the whole sector is moving and make sure that it's moving in a sound and stable manner. I mean, and then looking at collaboration as well, it's important, as I said, that sometimes the central bank is seen as big brother. So that comes from the fact that at the end of the day, financial supervisors oversee some form of, they oversee formal financial services providers. These may include, but they're not limited to your banks, your non-banks, such as e-money issuers or your insurers, whether they're traditional or digital. So they supervise them, but they're not just big brother, because at the end of the day, supervisors want to encourage as well innovation, and with the regulators, they want to encourage innovation. So they are open, my perception rather, let me say, is that most regulators are open to having discussions with private sector providers because those synergies are aligned. They both are interested in financial innovation and market development.
And I think we need to keep that in mind, that actually so many of us have the same goals, which are, are around increasing uptake and usage of digital finance, financial inclusion, and, keeping our economies, strong. And there's so many overlaps, there's so many things that we all have in common, yet somehow we don't quite always manage to collaborate as well as we could. And I think that might be another topic, Nolwazi, for another podcast. From what you've been saying there, I think that'll be an interesting discussion to have. And you began to touch on it a little bit in your answer, but innovation happens all the time. We just don't know what's around the corner. So, tomorrow we can learn about a whole brand new project. Cryptocurrency was something completely new for us, not that long ago. And now it's something a lot of people are exploring, or invested in, know about. There's going to be something new arriving on our doorsteps tomorrow. So how do regulators and supervisors deal with the innovation and encourage it as well? And how do they kind of balance that between making sure that any potential risks, particularly to end consumers, are really considered, and that the financial stability of the country as a whole is kept on track. Can you give us some insights on that?
Well, I think I'll start off talking about the role that supervisors play in this, in the sense that supervisors collect data, right? And the data they collect is used to create an evidence base for policy making. So policymakers and regulators can monitor market behavior and appetite for innovations within the institutions they supervise through the returns or data they collect from them. And then when you move from supervisor level to regulator level, we've seen that regulators have used various tools to encourage innovation. We've seen the use of regulatory sandboxes. We've seen the use of what we call innovation hubs. We've seen the use of office hours, where regulators have an open session and financial institutions can come in and consult with them and see how they can work with the regulator towards licensing or testing their new products. Another thing we've seen regulators use, as always, people refer back to the case of Kenya with M-Pesa, was a test and learn, watch and learn approach, I think, where they wanted to watch how the product was performing, learn from it, and then create the regulations around it. There's also the wait and see approach. So regulators have a lot of tools at their disposal, but these tools can also be informed by the data that's collected by supervisors to make sure that there's a solid evidence base that is guiding the next steps that policymakers and regulators make.
And then, we now know a lot more about the role of the supervisors and regulators. So sort of my kind of question is almost like, who oversees them, and where do they get their guidance from? So these standard setting bodies really do play a key role in guiding regulators and supervisors. So how does that work?
So an example I can give is the Bank for International Settlements, or popularly known the BIS. They're a global standard setting body and they have various committees, but I think the one specific for our discussion today is the Basel Committee on Bank Supervision, or the BCBS. So the BCBS is the primary global standard setter for prudential regulation of banks, and also provides a forum for cooperation on banking supervisory matters. So it's got members that could cooperate amongst each other, but then they also share what they've learned with other countries that can access those learnings and use them and see how they can collaborate them within their own context. So the mandate of the BCBS is aligned with the typical mandate of a central bank or a financial supervisor, which is to enhance financial stability. So you see there that there's motivation for regulators and supervisors to use the guidance given by the BCBS. So the BCBS shares guidance on supervisory approaches which can be implemented by a country, again, based on its specific context. And I really want to put a lot of emphasis on context, in the sense that countries can't just copy and paste regulations from each other, even if they think we're both developing countries. If it worked per se in Malawi, it should work in Lesotho. Contexts are very different, and it's important for regulators and supervisors to understand their specific context, then use guidance, international guidance, regional guidance on how they can apply it to their context. But one thing that I always think is important to note is that the BCBS, or the Basel Committee on Banking Supervision, does not possess any formal supranational authority. So that means that its decisions, its guidance, its advice is not legally enforceable in countries. So countries don't have to use their guidance towards their approaches, but as we've seen, they are an international standard setting body. So a lot of countries are using their guidance, and that helps, if anything, other central banks from other countries to trust your country if we're all using the same guidance, and avoids touching on things like de-risking, which we can talk about in another podcast. So I think, that gives a bit of a rounded view on, especially that difference. But let me hand over to you, Sarah, to give us a summary of your takeaways from our discussion today.
Well, I've learned so much. It's kind of difficult to pick 2 or 3 things, but let me share with you just a couple of things that have really resonated with me. So obviously, and firstly, financial regulation and financial supervision are definitely not the same thing. So no longer will I use those words interchangeably. Financial regulation informs the activities of financial supervision towards ensuring supervised financial institutions comply with regulations. I also heard you on that data collection thing. You know, when you were talking about the challenges, data collection seems to be one of the major challenges for supervisors in many jurisdictions. But this can be improved through effective and continued stakeholder engagement. And I think stakeholder engagement is definitely something we should explore in another podcast. Finally, we also talked about how actually, you know, supervisors play a really key role in enabling financial innovation in their jurisdictions through creating an evidence base that informs forward-looking policy making and regulations. And I think that's really exciting to know that there's constant, you know, that constant change is being looked at and addressed by supervisors and regulators. Nolwazi, I've really enjoyed the time with you today. I've learned a lot. I still think I need to absorb even more of the knowledge that you've given us. But perhaps we can close just by you telling us a little bit more, you know, if we want to learn more about supervising and regulating, how do we do that? Where should we go for our information?
I think that's a nice point, I guess, to end our discussion on, which I've thoroughly enjoyed myself. This is I have a great passion for financial regulation and supervision, so I'm always reading up everything that I see being published online. But I think just to start off, taking from some of the points you mentioned or your key takeaways, that relationships, good communication and openness are really key or important to allow for an environment that promotes innovation. So a lot of countries are thinking about now, we're seeing central bank digital currencies, and that needs a lot of collaboration because there's implications not only just for the financial system, but really the real economy at large. So promoting this innovation at the same time needs to have that gender and financial inclusion lens applied to it to make sure that no one is left behind. So I would encourage regulators and supervisors and those delivering financial services to have an open dialogue, to get to know and understand each other. And as I previously said, to learn how to speak each other's languages, because we're all speaking English or whatever the country in your the language in your jurisdiction is, but not really saying the same thing. So that open dialogue will help them understand each other and see each other, importantly, as collaborators and not opponents. So I think if you're still wanting to learn a bit more, I would love to see you in one of our courses. We always have live discussions with students, and it would be nice to see some faces, especially if you leave a comment on this video, if you're seeing it on YouTube, or we got the link from LinkedIn and you've shown your interest. We have a financial regulation and supervision faculty that we're setting up that looks at telling a story or giving a journey to students who are interested in financial regulation and supervisory topics. So if you're someone who, per se, maybe is in the private sector, or you've just started for a regulator, working for a regulator, and you have very little knowledge around regulation of digital financial services, I would advise you to take our Regulation of Digital Financial Services course, because this introductory course will give you the foundation to understand like your 4 basic enablers for DFS, the 4 basic regulatory enablers, and go further to talk about innovations and how regulators can think about or start talking about and thinking about how to regulate these. Whereas if you're already a seasoned or experienced regulator supervisor, if you're per se working in the payment systems department, or you're more interested in payments content, especially maybe if you're also working in the IT department and you're working on the infrastructure of your real-time gross settlement system, which is normally housed within the central bank, we have an instant and inclusive payment systems program. And in that program, we've got a course titled Regulating and Governing Instant and Inclusive Payment Systems. So I would advise you to explore that course, which is completely underwritten by the Bill and Melinda Gates Foundation, thereby you don't have to pay a fee to take that course. And lastly, if you are as well a seasoned regulator with a lot of experience, we've got a new program coming up, which I'm very, very excited about because I'm working on developing it. It's a collaborative effort between Digital Frontiers, Toronto Centre, and CGAP. And this new program is titled Digital Financial Inclusion Supervision, which aims to discuss, or rather create a learning platform on how to align financial supervision objectives with inclusive digital financial services. So that means that we're not just saying supervision should be open or sloppy, but it should still maintain its core foundation mandate of soundness and financial stability, but also enabling inclusive digital financial services. So in this program, you'll actually get a practical experience where you can develop a practical action plan for a specific challenge or problem statement in your country. Like, as we said, data collection is a major challenge. And through that, we'll work with you on how to identify your stakeholders, how to develop a project plan practically that you can apply in your country on how to work on fixing or improving this challenge that you're facing. So I really would be happy to see some of you there. One thing to mention is our upcoming program, though, on supervision is particularly aimed at regulators and supervisors. So we're looking for them to apply or register interest for our course. Thank you. I think this has been a great chat, Sarah.
Thanks so much, Nolwazi. It's great to know that there's further avenues to explore, and we'll put the links below the video as well, so that those people who wish to can explore more. And as I said, we definitely knew you were going to talk about everything to do with supervision and regulation, and we've just scraped the beginning part of that conversation, so there's going to be many more to come. Thank you so much, Nolwazi. Thank you to everyone for listening, and we hope to see you again, either on a podcast, a webinar, or one of our courses soon. Bye-bye.
Bye.